Question number 5, consider the following observed performance for two securities, J and K at Osaka Stock Exchange. So which of the two stocks has higher risk? Explain, compute, and explain systematic risk for each of the securities. Explain the diversification potential for each security. Okay, so how do we answer such a question? How do we answer such a question, Meanda?
So we find the average, you find the mean by averaging the percentages for J and K.
Okay, so we add and divide by how many years are these?
5.
5. Okay, so we add -2 plus 2 is 0. 5 plus 8 is 13. Then what do you do?
13.
Mhm.
So it's 13 divided by 5.
Which is what? 6 point?
13 divided by, which is
6.5. 13 divided by
not
5.
2,
2 point what?
about 2.6, I think.
13 divided by 5, which is 2.6, yes.
Okay.
Then
Please give me a minute. I will be listening, but I just need to switch devices, so it's clear on.
okay. Then Mr. Francis, what do you do to this one? What are we getting when you average this one?
Yeah, sorry, sir. I've just joined in, sir. I don't even know which paper you are doing and which question you are doing, sir. Sorry, sir.
So we're looking at question number 5, where we are given two securities, J and
That
K.
question pamphlet, sir?
Yes, on the pamphlet, yeah.
Yes, sir.
So we want to calculate. The averages. Can you see? So we want to get the average for each stock. So we have stock J and stock K. So we just added and divided by 5 in this line.
Yes. Yes, sir.
So also add for me here and divide by 5 in this minus. Okay, minus 1, minus
Is that on?
2, minus, So this is 8.6 minus 1.2. 8.6 minus 8.6 minus 1.2, 7.4 divided by 5. We get 1.48. Is that correct? I hope you have a calculator.
Dividing by 5, sir.
Yes. So when you add all these, divide by 5, we get 1.48.
1.48.
Is it? Confirm?
Yeah, I think I was getting 1.76. I don't know. Maybe I was going too fast or something.
So this is 6 plus 2 is 8. All right? 8 plus 0.6 is 8.6. 8.6 minus 1? 7.
Oh, yes.
7.6 minus 0.2? 7.4. You divide by 5, you get 1.48. Okay, so what do we do next? Even here we average. So this is 4 plus 2 is 6. 6 minus 6 is 0. Okay. So the question is, which of the two stocks has higher risk? So the percentages that we are having here are showing the performance of our stock. All right. So which of the two stocks has higher risk? How do we calculate the risk? Yes, Mianda?
So we find the standard deviation. Case it to be your percentages, subtract the expected return, the sum of that, and then divide by the n.
Okay. So after finding the averages for each of these ones, but the question is, how do we calculate? What was the question? We want to calculate which of the stocks has higher risk. So by risk here, we're looking at the standard deviations for the returns, right? So how do we calculate the standard deviations? We subtract each of them by what?
The return minus mean.
Minus the mean we found on each of them.
We square.
We square, then we divide by the what?
We divide by n.
By n. Okay.
Minus 1.
So after finding this from each of these ones, we're going to subtract minus what? 2.6. Okay. And you square the answer, right?
Yes.
Minus 2.6. You square the answer. Minus 2.6. You square the answer. Minus 2.6. Square the answer. Minus 2.6. Square the answer. Do the same on each of these ones. So here, this is minus 4.8. That's 4.8. That's 1.48, sorry. 1.48. 1.48. 1.48. Then we square each of these ones. Then divide by what? The n. Okay, so the mean for J was 2.6 and for K was 1.48. Okay. What values did you find? So J was what? 2.6 and 1.48. Okay, so after you find the answer, trying to find what values did you get? Should you put arbitrary values, or we use actual values in case it comes directly? I hope you have your calculators. So what did you find here as a total? And you divide by 5. Okay.
For the variance, are you referring to the variance?
Yes. So
okay.
So
For Luce, 8.
For Luce, you found 8 as a variance. For this one,
Okay, 12.64.
here or here?
Yeah,
This one?
that one.
12?
Yeah, that one.
12.64. And here?
6.0896.
0896. Okay. So we found, yes, so Lucid was 8%. Then A was 12 point what?
12.64.
12.64.
And then J 6.0896.
Okay. So having those answers, what would be our conclusion on?
So that's the variance, right? So we still need to find the square root.
So for the variances, yes. So we found those variances. Then what we do, we square root them to find the standard deviations. So what is the standard deviation for J? Oh, let's start from here. What are the standard deviations here?
That's 2.83.
3. Here,
3.55, 3.56.
2.56. And here,
Not 3.53.
3.5.
3.5.
And here,
That's what? 6.0.
2.467.
okay. 2 point what? 2.47.
467.
7. So what would our conclusion therefore be? So the total risk of the security is actually measured by a standard deviation, which is the square root of the variance, which we've already done. Okay, so standard deviation for J, for K. So which stock has a total, which one has a higher risk?
That's J.
J has a high risk.
So J has a higher risk. Why? Because it has what? A higher standard
That's the
deviation. Okay. So these are the computations that we found. So the variation, the total risk is calculated by the standard deviation. So we'll pick on J. So we found J of this and this, and have to find the standard deviation. Right. The next question.
maybe just a clarification, sir.
Mhm.
I think I've seen in the other papers where they just use N, and I think when they're trying to find the expected return, where they use N, and when they're trying to find the standard deviation, they use N-1. So I don't know which is which, sir.
N-1 is for a sample, creating a sample population usually in statistics. But for here, it's a population, the entire population of access.
Oh, all right.
Okay.
So N-1 is for sample.
Yes. Then now, how do we find, compute and explain the systematic risk? How do you find the risk? How do you find the systematic risk? So systematic risk measures
Is it a beta or
the beta, yes, it's measured by beta, and beta wants to measure how much the stock's return move in the direction. So here we are calculating beta by, how do you calculate the beta?
It's the covariance of the security and the market divided by the variance of the market.
Correct. Okay. So calculate our beta. We calculate it as follows. Formula is as beamed above for variance of the stock times the market over the variance of the market. So we compute beta by using the covariance of the stocks. We divide it by the over. So how do you find the covariance of stock? What is the covariance of stock? The covariance of stock in the market. For we can say we're going to calculate two betas. Okay, we have the beta for J and the beta for K. Do we have information for that? Pardon, do we have information?
Yes, we do.
Okay, let's go back to our question. What information do we have?
So we have it's the sum of, to find the covariance for J, versus the market. We need the sum of returns for J minus the expected return times the returns for Luce minus the expected returns for Luce.
So we multiply these two.
N.
Yeah. So what did we get here? So each of them against the market, right? So here we're
Yeah.
subtracting minus 8, minus 8, minus 8, minus 8, minus 8. Okay. So this question was done. So what did you find your covariance for J against the market?
0.1.
That was the final answer?
Or do you need us to go through the entire
No,
calculation?
we don't need, just to get the concept.
Okay, so for covariance, it was 0.1.
Okay, covariance Rj was 0.1. But covariance Rk times market was what?
Okay, it was 6.8. I didn't divide this one. So 0.0648.
It was what?
0.0648.
And what was the market variance? What was the market variance?
So when you say market
The
okay.
variance of the
8.
market. It was what?
For the first one,
The one we
it's
got
8.
8, right? Okay. So with those parameters, how do we now calculate? So the beta for J would be what? Using that data. So the covariance. So the covariance for the return on J times market, we say 0.1, right? Covariance for return on K times market was 0.0648, right? Then the market was 8%, or 0.0. So to find the beta is covariance stock against the market. So we're looking at the beta for J, 0.1 over, that it was 8%, isn't it? Which is 0.08.
Yes, over
So we're
8.
going to find 1.25. Then the beta for market was 0.0648 over 0.08, which is what? 0.81. So from these solutions, what becomes the conclusion? And comparing the beta for J was 1.25. What does it mean? That it's more volatile than the market. Okay. How about the beta for K, which is 0.81? What does it mean? It's less volatile. When it is exactly 1, it means it's moving alongside with the market, isn't it? So
Yes.
it's an interpretation.
So we take it the beta for the market will always be 1.
Yes, if you're just moving along the market, anything above it's more volatile. Anything below it's less volatile. Okay. Okay. So now let's go back to compute and explain diversification potential for each security. So what are we doing here? So diversification potential here, we're looking at what? The securities risk, especially when we're dealing with systematic risk. This one, which can be reduced by diversifying. So stocks that are less correlated in the market will provide better diversification potential because their returns do not move in sync. So there's some of the factors that will foster stocks some of the key factors that we need to consider. Okay, number one, we need to consider the total risk. Okay, when calculating diversifying potential or the diversification potential, what are some of the factors that we must consider? Number one, we need to consider what? The total risk. So stocks with a higher total risk are usually less favorable for diversification. The other thing you need to consider is systematic risk beta. So if you have a stock less than one, it is less sensitive. More than one, it's more sensitive. So this is another consideration. The third consideration you must look at is the correlation with the market. If you have a lower correlation with the market, it also increases the diversification potential. So when calculating diversification potential, you need to use the data for systematic risk and the total risk of each security to assess the diversification potential. So in this case, our stock J had a beta of 1.25 and a total standard deviation of 2.47, whereas stock K had a beta of 0.81 with a total standard deviation of 3.56 in this case, right? So what can we say about the diversification potential? So diversification potential is based on the data, right? The diversification potential is based on the data that we have. So when calculating that, let's look at diversification potential based on beta. So based on beta, stock J has 1.25, which is greater than 1. It means that it has higher systematic risk compared to the market, and it implies that it moves in sync with the market. So J is likely to not offer much diversification potential because its returns are more correlated with the overall market. Then when we look at stock K, which has 0.81, is less than 1, so meaning it's less sensitive to market movements and could provide better diversification potential in the portfolio. Why? Because its price movements are less likely to be influenced by the overall market. Then diversification potential based on total risk. So J has a lower risk of 4.7 compared to stock K, which is 0.58. So a standard deviation that is lower indicates that it has low total risk. So it makes it potentially better diversifying tool for the portfolio, particularly for the risk-averse investors. And when you're looking at stock K, it has a higher total risk of 3.56, so meaning the price is more volatile. However, we can still say that this is because it has a lower systematic risk of 0.81, and it may still offer diversification benefits in a portfolio that needs what? A combination of high, low risk assets. So in a nutshell, or in summary, we can simply say that stock J, given that it has a higher beta of 1.2, is more sensitive to the market movements, and its diversification potential in the portfolio is lower. However, it has lower risk and could still be beneficial in reducing what? Risk in the entire portfolio. K, on the other hand, has a lower what? Beta of 0.81, so it makes it less sensitive to market movements and more suitable for diversification in the portfolio. So even though it has a higher total risk, its lower beta compensates in terms of diversification potential. So in this case, we can say stock A has better diversification potential than stock J, primarily due to the lower beta. So we're looking at the beta and has a lower correlation with the market. So it's about analyzing what information we have. So 20 marks, is that clear?
Yes, thank you. I just wanted to get some clarification again in relation to the question that was previously asked. When we're using a sample, it's n minus 1. But at what point do we start using that n minus 1? Is it at the point of calculating the mean?
The standard deviation, the mean doesn't have n minus 1. It's a standard deviation. If you have 20 assets, okay, in the entire stock, and from the 20 assets of the stock, and you're just told that we are considering only 5, that is a sample, right? That's where we use the n minus 1. But when we are calculating for the entire population, all of them, we divide by n.
Okay. Thank you.
Okay, so I wanted to do this question because you had asked about it. I hope it clarifies your concerns.
Yes, it does. Thank you very much.
Okay. When are you writing this paper?
On the 12th.
The 12th, okay. So, which other question do we? Okay, let's try to look at question number 11. Okay, question number 11. This one here. Okay, so we are told that you need to consider a 12-month to security potential investment from the following three. The correlation coefficient between pairs of the stocks is as follows. Correlation AB is 0.85. The correlation AC is 0.60.
Okay, so, you haven't yet projected that question?
Hello? Can you see the question?
Yes, it's appeared.
Okay. So we are told that we have correlation AB 0.85, AC 0.60, AD 0.45. So each of the stock has expected return of 8% and deviation of 20%. Your entire portfolio is now composed of A, and you can add some of only one stock to your portfolio. Okay. So identify the stock added to stock A and determine the optimum portfolio mix. But B of E is the overall rate of return at Lucy is 9%, risk-free rate 4%, and beta 1.2 is justifiable in the new portfolio. Okay, let's start with suppose part A, part D. Identify the stock we added to A means optimum portfolio mix. How do we solve this question? Identify the stock to be added to A to determine the optimum portfolio mix. So
Okay.
A has an
Based on the correlation, I think it would be 0.45. That's the correlation for AD. So I would assume D would be the best stock to add because it has got more diversification potential, considering that they are literally in almost opposite directions or the least related.
Yes, the answer is correct, but I don't know how you've guessed it. You're using by just looking at it.
No, based on because remember in the previous question, you explained what correlation means.
Yes,
And its effect on diversification. So here, what I looked at is just the correlation for AB, AC, and AD. And the lowest there is AD. So already that suggests to say, that's a pointer.
Okay. All right. So it's those are how many marks?
8.
Those are 8 marks. Okay. So you'll be very lucky to just get it by observations, but the answer is correct. So first, we need to understand the information that we've been given. So stock A has an expected return of 8% and standard deviation of 20. The correlation pairs we are given as follows. So we can only add one stock to A to form a two-stock portfolio. So we know that portfolio standard deviation is given by the weight, variance as this plus correlation, that one. So where these are weights and correlations are that. Step one. Are we together on that? From our corporate finance, we know that. Okay.
Yes.
So, so the step one, we need to identify the information. Step two, the portfolio standard deviation formula. Step three, we now need to calculate the portfolio standard deviation for each of the stock. So we can start by first adding stock B, then adding stock D, then adding stock up to stock D in this formula that we have. So we start by adding stock B, correlation A B, okay, which is that one. Okay. Standard deviation for A, standard deviation for B, when you put it in there, okay, you get your of course we don't have the weights there, just to justify your answer. Then when you do this, adding to stock B, this is that. All right. Stock D, this is that. Then our third step is now we need to optimize to um, find the optimal mix. Okay, so since we don't have figures there, just to justify your 8 marks, we can just give an explanation in the last step to say to minimize the portfolio, we need to find the optimal weight of A. Okay, we also need, this can be done by taking a derivative portfolio in respect to the weight of A. However, from the correlation values, we can directly compare the portfolios by observing the following. B has a correlation, like you said, of 0.85 with the stock A, meaning the two stocks move similarly, reducing diversification benefits. So this will lead to a higher risk of the portfolio. Stock C has a correlation of 0.6 with stock A with a moderate, leading to some diversification, whereas D has the lowest of 0.45, okay, with A. So it has provided the highest diversification benefit. So in this case, we're going to move with what? Stock D, which provides the best benefit for diversification. So D is the answer already said. But in the case that you were given weights, you needed to actually calculate to show that, okay? So here we don't have weights, fortunately. So it was just an issue of understanding. But I'm glad you followed through what I had talked about earlier. Is that okay?
Maybe,
Yeah.
maybe
So
quickly,
just
yeah, I haven't really gotten what you're trying to explain there.
okay, let me also add my question to that so that you tackle them at the same time. So what we're saying is that in a case like this, where you're given all the necessary information, we first have to calculate the standard deviation for all the variables to identify which portfolio has got more risk or less risk.
Yes. That's
And then we use the correlations to justify our pick.
because you need to calculate now the portfolio standard deviation for each stock. So if you're given weight, you need to calculate now the portfolio, uh, um, the portfolio standard deviation for each of them. Okay. All right, because it's important. The standard deviation will show you of the three, a combination that gives you the lowest risk. It's also an element in choosing.
Okay,
And
thank you.
lastly, that's when you now calculate. Okay, so exactly. So we've answered our question. What is remaining? So part B now. If the overall rate of return loses 9%, risk-free rate 4%, beta 1.2, is it justifiable to invest in the new portfolio? What's your take? So here using the what? The Iapm model. So you need to calculate the expected return. Okay. And our market rate in this case is what?
9%.
9%. So here we are trying to calculate the new market return. If it's higher than the 9%, what does it mean? The portfolio can outperform the market. If it's lower, the performance will be lower. So we only get it, we only say yes if it's above the 9%, right? If it's below the 9%.
Yeah.
Yeah. So we apply our Iapm formula. So with the given data, what is the Iapm formula for calculating expected return?
Risk-free.
Yes, risk-free rate.
Plus beta.
Open bracket, the return market return minus risk-free.
That's risk-free rate, correct. So we're given the data here. The risk-free rate is 4%. Market rate is 9%. So 9 minus 4%, and beta has been given as 1.2. So our expected return has been found to be 10% compared to the 9%. So we are outperforming the market. So our question is, is it justifiable to take this new portfolio? Is it?
Yes, it's justifiable
Yes,
to
it
get
is.
Yeah.
portfolio.
Okay, so it's justifiable, yes. So because we are outperforming the market, so we can say yes, it's justifiable, right? So the explanation is in the formulas and your calculations. So is that clear?
Before we move on, yes, it is. Just on the formula there, where you wrote the formula,
Yes.
your beta times RF minus RM. That is, what is that called?
The premium.
That's the market premium.
Yes, yes.
And then what is the RF minus RM called?
So the formula, this is RF plus beta. Okay, the expected market minus RF. This is what we call the premium, this one here, the risk premium.
That's for RM minus RF. That's the risk premium.
Yeah. So sometimes if you're not given the market return, they'll just give you the risk-free rate and market premium. So just put it here. The difference here is actually your market premium, the premium.
Okay.
Yeah.
Is there a specific term that refers to the beta minus the market premium?
We'd never have beta minus. This is multiplying here.
Sorry, not minus. Sorry, beta times market premium. Is there a term for that?
Oh, okay. So the answer between this whole thing here.
Yes.
Have you ever heard of any?
I thought I did, which puzzled me a little bit. It was something related to something premium as well, but I couldn't quite grasp it. That's why I thought, no, let me see clarification first.
Okay, so the beta times market premium. Have you heard of that? Sir Francis.
Yeah, not really. I'm not, I think.
But what was the explanation in your reading?
Okay, no, I'll find it, then I'll try and share with you.
Was market premium. Maybe you had equity market premium. Did you hear something like that?
I'll look for it and I'll share
Okay.
it with you. I'm pretty certain it was beta.
Okay. All right. Then we go to our part D, discuss the assumption of keeping correlations between stock returns constant